Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is General Motors. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby, the Senior Options Analyst at Ally Invest. Today, we're going to talk about General Motors. Before we get there, though, let's take a quick peek at the markets. I'm currently showing a chart on the S&P 500 index. And we had a solid day today. Inside the S&P 500 index, concern about the variants that are going around with the coronavirus has waned a little bit. And that has driven the markets higher today. And so what we saw in the S&P 500 index, I should say last week, we highlighted that we're really at an area of support. We have the 50-day moving average, which has been a very good level of support throughout the entire year. We had a couple of times where we broke down, things got a little nerve-wracking overall. Last week, we had a bad jobs report. Well, at least the marketplace perceived it. The term inflation came in again. Everybody kind of panicked a little bit, but all we did was come down to the 50-day moving average here, the red line. We also had this level of support, which was a strong level on the breakout to the upside. It was a strong level of resistance overall. And once we had that breakout, we had 1, 2, 3, 4, 5, 6, 7 green candles, very strong movement in the marketplace at that point in time. So we came down and we bounced. We bounced off the 50-day, we bounced off that trend line. And now we're having a really good solid update. And for the first time in a couple of, I say in about a week, first of all, let's run over here and look at the VIX. First time in about a week, we actually had some real movement to the downside in the VIX. We're down right now about 18% or 5 points, but the VIX overall had a huge spike up. And if you see this, and I can zoom in a little bit more on my VIX chart over here. We just were hanging right around the 27 and 30 range in the VIX for quite some time, which the marketplace the marketplace was volatile overall. We were having some fairly wild swings in the marketplace just on a daily historical basis last week. But usually the VIX is driven more so by angst in the marketplace, by being nervous about what's going on. So people are buying options, protective options usually, like protective puts in the S&P 500 index. The more people that are buying that portfolio protection, a lot of times institutional money managers, is what really will drive up the VIX, because the more people that come to buy, the higher the demand, they increase the price, which increases the implied volatility. Now, that's irrelevant to the actual price movement. So besides the price and where the stock is at, we get the VIX to spike up. Well, a lot of people were willing to pay for it, and the VIX was just staying elevated, even though the marketplace wasn't really in a panic mode. So this is the first time, I think, a solid sign on a bull move to the upside as far as the VIX is concerned. And we saw this drop all the way down. We're down to the 22 level. Still considered high implied volatility. The 1 year average in the VIX is right around 19%, right down by this 20 line. So I would still consider that we are in high volatility as far as the VIX and the S&P 500 index is concerned. But real good sign, real solid move to the upside in the SPX, and a solid move to the downside in the VIX. Now, what's really driving the marketplace too today is the NASDAQ. The NASDAQ is up nearly 3% today. Very solid move. And that was, the NASDAQ was the laggard. So A lot of the tech stocks were driving the market down. Nice to see a pop there. We have all of the moving averages in line. We got the 200-day, the 50-day, and the 20-day. They're all our ducks are in a row. So right now, this is the first time over the last couple of weeks where the charts and the markets in general are showing some good signs going into the new year, which is usually overall, December is usually a better month. We struggle through October, September, a little bit in November. We get into the retail period where a lot of people start buying and spending money. And usually it's a good sign for the marketplace in general. So kind of odd that we were having, some trials and tribulations in the marketplace. People were talking about 2018 when we actually kind of had a flash crash in December. But if you went out to the malls and started shopping, before you know it, when he came back and got a quote in the new year, the flash crash was always already over with. So it was a real weird move in 2018 in the S&P 500 index. But right now, today is the first time we've had a solid looking markets in quite some time over the last couple of weeks. Okay, so how are we going to approach this marketplace then? Well, we talked about the EV space. The EV space has obviously drawn a lot of attention all the way back to Tesla, way back in the day, which was our leader in the EV space. In October, we talked about Ford. The date was October 8th, episode 81, about Ford now becoming the cool company, because for some reason everybody thinks if you are building EV cars, that is the cool space to be in, because Ford was trading down around 7 times earnings, trading right around $10 or so for the longest time, and just couldn't get any traction until they announced that they were making a big investment in the EV space. The stock popped. We talked about it on October 8th. The stock was around 15. Stock is now around 19, but it's still only trading at about 10.5 times earnings. Real solid fundamentals in the company. And also around that time, GM announced that they are going to start focusing more in the EV space overall. So if I show the chart here, let me get to it on GM. We had a little bit more volatility than we did in the Ford space, but this is going to be the stock that we're going to look at today. We're going to look at an option trade on it. And if we see this here, we had a little bit of a downturn all the way down to the 46 level recently. And if you see that, that's where we had kind of a gap opening. You see where that level of support was right in here. This was a high all the way back in December, came back down, and then we gapped through it, came back down to this range. Now, once again, we have different levels of we have our ducks in the row on the moving averages. So recently we had the 20-day cross over the 50-day, and then we had the 20-day cross over the 200-day. Now those are considered golden crosses. We also had that happen recently where the 50-day crossed over the 200-day. Ducks are now in a row, 200, 50, 20. Usually that's a sign of a solid marketplace when you have all the moving averages pointing upward and all in a row. You got the 20 above the 50, above the 200. So solid update today, a little bit of volatility. A new high is all the way up here around 65. How could we approach GM using option contracts to invest in a longer term outlook in the EV space? On Ford, we actually looked at a covered call on Ford and talked a little bit about longer term options. So I'm going to propose, and as always here on the stock play of the day, not meant to be a recommendation, we're going to look at buying LEAPS, and hence the title. GM's going to GM leaps into the EV space. LEAPS just is a marketing term that was developed by the Chicago Board Option Exchange. It's an acronym. It stands for Long-Term Equity Anticipation Securities. Just means that they're longer dated option contracts. There's really no reason to have a specific acronym for them. Overall, they're not much different. But inside the options playbook here, I'm highlighting our section that we call the Rookies Corner. And we are talking about buying a LEAPS as a substitute for buying the stock outright. The biggest thing about buying LEAPS is you need to have decent markets, bid-ask spreads, the width of them, and you go out longer term, gives you a little bit of protection. If you were going to buy 100 shares of GM, we would look at buying a one option contract. We're going to go out longer in time. We're going to go out to June of next year, and we're going to get some delta. We're going to buy a real option contract here. Now, if I run to the GM option chains, we see that General Motors is up today. It's up about 4%, so solid move. Up $2.35 on the day. I always like to buy on up days if you can. It would be really nice if we're breaking out to a new high. We're not quite there yet, but the chart does look solid overall with all the golden crosses that have happened recently. And we're going to go all the way out to the June expiration. So that's 192 days away. Now, we talked about Delta, and I'll run to the options playbook here shortly, and I'll show you the section on Delta. 1 second. Excuse me. But in this instance, I see that the delta is 0.81. That means that if the underlying stock goes up 1, we would expect our option contract to go up 81 cents. If we bought 100 shares of GM outright, that would be $6,200. It's a $62 stock. It's not that expensive. When we looked at Ford was a $15 stock, and why buy the options, right? 15, you can buy 100 shares of stock for $1,500. That's why we looked at a covered call in Ford. Here, we're a little bit more expensive, so it might make sense to actually buy a LEAP, limit your risk, and still participate in the stock price movement. So here, in this instance, we have the option contract is 1455 by 1475, 20-cent wide bid-ask spread. Now the stock is only a penny wide, and this is the situation with the option contracts. If I'll be blunt, if the markets were a penny wide on LEAPS, I don't think hardly anybody would really be buying stock overall, except for the simplicity of it, because why would you spend all that money, $6,200, to buy 100 shares of stock when you can participate and get the same type of movement, very similar, and only spend $1,400, $1,470 if you buy on the ask overall. And we're going to go out to June, though. It does have an expiration date, and that is a downside. But one of the great things about buying in the money option contracts is as it gets more and more in the money, the delta increases. And I can highlight that. So you actually kind of pick up more shares if you're correct on your forecast. So in this instance, if you're looking at the 55 strike, right, that's not as deep in the money, and that's got a 72 delta. And now we have the 50 strike, and that's got an 81 delta. So as we go further and further in the money, delta gets bigger, you get more stock price representation, and obviously the price of your option contract increases. But the issue is we have to pay a 20-cent premium to try to get into this trade overall. The difference between the bid and ask. So if we bought it right away at 1470, turned around, now it's a live market, so it's moving, turned around, sold it at 1445, well, obviously we'd have a decent percentage loss on that trade. And that's what I'm talking about with the liquidity. Now, both Ford and GM option contracts do trade fairly heavily. There's decent open interest. We look at this, the open interest is 8,183. Now that's a number that means that there's that many contracts that are out there. You can kind of think of it as the number of shares available in an underlying stock. This is the number of option contracts that are out there, 8,183. That means there's a buyer and there's a seller on each side of it. The more open interest that you have, usually the tighter the markets will be overall. Okay, so this would be the official paper trade, very straightforward. I'm going to put it in the right rail. I apologize, I got a little tickle in my throat today. But we're going to try to work it. Now, if you're buying these option contracts today, the total volume is 47 contracts that have traded, not a ton. It's a little hard to trade at a midpoint, but we're buying to open the June 2022 50 strike call option. Midpoint is 1460. We'll go 1465. Okay, that's where I would try to work this. Now, if I'm trading longer term options, I'm always going to try to work it. In other words, I'm going to come in somewhere between the bid and the ask and put in a limit and hopefully get somebody to take that other side of that trade. Like I said, the midpoint is kind of tough to get here. We got 20 cent wide. I think 1465 is solid. Never a guarantee of fill whenever you put a limit on it. If you want to guarantee the fill, you got to go market overall. It would be a day order. So our total risk on this trade would be for $1,465 as opposed to the $6,211 if we bought the stock outright. We got something that acts a lot like the stock overall. We got an 81 delta. It means stock goes up 1. We would expect this option contract to go up about 80 cents. And we've limited our risk. Now, here's the whole difference here in that if you were normally going to buy 100 shares of stock and you only buy one option contract, in this instance, you're using options as they were intended to actually defer risk on the trade. I am limiting my risk to that amount that I paid for it. Could GM go down by $14? Yeah, it could. I don't think that at this point in time, could GM go to zero? Where if you bought the stock and you lost everything, that is much more unlikely. But a $14 move, that's feasible when you're talking about stocks in the EV space, especially if you look at stocks like Tesla and how much that underlying stock can move over not only on a daily basis, but over a long period, like we are talking about here, where we're talking about 192 days. Now, you don't own the stock. So you want to be aware of that, and that you still own the option contract. You have the right to buy the stock, but you want to look at this position as if I get closer to that expiration date, do I want to roll the option contract out in time, or do I want to purchase the stock at that point in time? And also another way that I look at this trade is, one of the good things about longer term options is that if we were incorrect on our forecast and the stock actually came down to the strike overall, you lose money at a slower pace because, as I mentioned, as we get deeper and deeper in the money, we pick up delta, which acts more and more like the stock. But as we go further and further out of the money, we actually lose delta. So for example, if the delta gets smaller, I shouldn't say we lose delta, the delta gets smaller, and so it doesn't hurt you as bad on the downside. And so let's think of this, okay? Right now the stock is at 62. The strike price is the 62.50 is the most at the money option contract. It's trading for $7. And this is how I always kind of approach my longer term option trading if I bought this as an alternative to buying the stock. If the stock went down 12.5 points, went down to the 50 strike, or 12 points to be more accurate, if that happened, this would be the at the money option contract. What's the at the money option contract trading for right now? $7. Guess what this should be trading for? Approximately $7. Now, it's an approximate. Implied volatilities can change. Obviously, as days to expiration approach, time decay will whittle away a little bit at it. But the stock would go down 12, and on our position, we would lose about 7. So on the way down, we don't lose as quickly. On the way up, we gain delta, and we start acting more and more like the stock on the way up. So like I said, if these markets were tighter, they're 20 cent wide right now, a lot more people would just be buying longer term options as an alternative to buying the stock. And every 190 days or so, you just roll out your option contract if you wanted to overall. So I'm wondering if that generated a lot of questions, but we talked about, if you want to go back and look at Ford, we did mention Ford. We'll probably have Ford on the show here again, another stock to chat about. But that was episode number 81 on October 8th. You can see it in the Stock Play of the Day playlist. And then if you have any questions, put them in the chat box. I forgot to mention that, but I see a lot of you out there. And if this has sparked any interest, if you want to learn even more about the basics of options, which I think option pricing is contained, or a lot of the basics on option pricing we just went through in our rookies course, which is a playlist inside at the ally.com YouTube channel. Episode 2 of a 3-part series. Part 2 gets into option pricing, talks in detail about Delta overall. All right, so William's got a question. On a LEAP, which actually, William, it's pronounced on a LEAPS because it's an acronym, but other than being exposed to a gap, why wouldn't one just put a good till cancel versus a day and not have to do this every day, maybe on a week? Yeah, you can enter it as a good till cancel. Just don't forget about it. So I'm still showing our situation here. Here is a good till cancel. If we wanted to enter it as a good till cancel and let it work, you could do that. Well, actually, look at this right here. The natural right now is at 1465. So that one would have got filled more than likely. 1455 is at the midpoint right now. So I'm going to close this, and I'm actually, before we get too far in the question, yeah, so William, yes, you could do that if you would like to. I would expect to get filled prior to that, but you can enter a good till canceled order on a LEAP. Not a problem whatsoever on a LEAPS limit order. But I want to kind of highlight this and talk a little bit. This profit and loss graph that I'm showing you, this kind of shows you the delta too. So for example, here's where the underlying stock is at. And I'm going to explain delta by looking at the colored line here, right? Okay, the colored line is as of today. So on the way up, look at the rise over the run. It becomes much, much, much steeper if we're correct on our forecast. And if the market comes down, it's not as steep. And right at the 50 level, if this were to happen today, like I highlighted using the chains, and I've always seen with instructing about options, the different, you try to tell the story as many ways as you possibly can. So in this instance, if it comes down, we still have a lot of that time premium, and it always focuses on at the money option contracts. That's where that time premium is really sticky. And so on the way down, we have a slower loss than on the way up when we are buying in the money option contracts. So my goal would be, I would want an alert at 50. The stock got to 50, I'd probably get out of the trade. The chart wouldn't look that good either, based off everything that we looked at. So that would be my out point for sure. Now you can always say to yourself too that if I, lost $300, I'll get out of this trade overall, or however you want to approach it. But this is usually the way that I like to look at LEAPS. I'm buying it. If it ever comes down to my strike and it becomes an at the money option contract, that's my out point. That's when I'm going to get out of the trade. All right, a couple other questions. Why can't I sell a stock while the covered call is active? All right, DH. If you sell the stock and you have a short call position, which would be a covered call, which we talked about in Ford on October 8th, if you sell the stock, you are no longer covered. You would be short a call option, which has unlimited risk as the stock goes up. So you have to be approved for unlimited risk or naked call writing. And if you're in an IRA account or any type of retirement account, they will never let you do that. They'll never let you short a stock. They'll never let you do an option strategy that has unlimited risk. But if you're in a regular brokerage account, if you get approved for naked option writing, you can then sell the stock. But once again, you're not covered overall. All right, a couple other great questions here. 1 second. Struggling with my cough today. What happens if you sell a covered call on GM and the trade is assigned before the LEAP expires. Okay. So Augustine is talking about selling a call against our long-term option as opposed to selling a call against the stock. What happens if it gets assigned? If it gets assigned, you're going to want to sell the LEAP because you want to capture the time premium, and then you go out and buy the stock. You will have 1 day to process this. But if that does happen, that's the best case scenario for you in that you would be buying the stock at a higher price than what you get assigned at, right? Because that's why you got assigned, because it got in the money. So you would be putting in a short-term loss in your account overall, but then you go out and you should have a capital gain on your long-term option contract. So it is tricky. If you are buying LEAPS, and I'm going to run to the options playbook and we can highlight this, as a substitute, I also want you to look at managing positions. I don't mind that strategy where I sell a call against it, but I want to consider rolling a covered call. Because if I do sell a call against my GM LEAP, I do not want to be assigned because I do not own the stock. So I'm going to do everything I can to avoid assignment. And this is one way to try to avoid assignment, is rolling a covered call. So this would be your required reading if you wanted to sell a shorter term option against that position. Okay, Ram Man, can you do a show for options portfolio for 2020? How to diversify strategies and holdings? Yeah, we could do that. I will be solo for the rest of the year, which gives me a little bit more time to talk overall. So we could look at how to diversify. So if you were looking at the EV space, you could buy a Ford LEAP and a GM LEAP, leave some money in cash. That would be one way to play this EV space and have limited and known risk, and use LEAP options as they were intended to actually limit the downside of playing in this space overall. So maybe you try to do that with liquid underlines. You wanted to, as opposed to owning Apple, which just set an all-time high, I think either today or yesterday. I got an alert at some point in time. Maybe you think about selling Apple and buying a LEAP option. As long as they're liquid underlines, it's possible to do that overall. 1 second here. All right, I had to get that cough out. Okay, so let's answer the last couple of questions. Regarding the GM LEAP, in 192 days, what are the advantages and disadvantages to selling a monthly in-the-money call for little protection if the stock price drops? The disadvantage is if it goes up too fast. So you're giving up an opportunity cost to the upside if I'm selling that shorter term option against it. And that is actually, we call this trade, and I haven't used the term, but inside the options playbook, we actually call this a LEAPS option. So we're Rookie's Corner. Option strategy. I'm looking for LEAPS. Oh, here's where it is. Let's go in option strategies and rookies. Veterans? Yeah, fig leaf. So this is actually the fig leaf. There you go. I don't know why it took me so long to figure out in my own book where the fig leaf was. But here's the fig leaf. And a lot of people call that a leveraged covered call. We titled it the fig leaf. The name is kind of taken off. A lot of people reference it that way because you're kind of covered. And we actually highlight the name of that at the bottom of this. This was actually suggested by someone in our trader network back in the day. And his name was Weird Uncle Jesse. And Weird Uncle Jesse kind of said that, well, the fig leaf would make sense to me because you're kind of covered by doing a fig leaf. You don't own the stock, you own the LEAPS option, you own the longer term option contract, but you own something that acts a lot like the stock. Biggest thing is you don't want to get assigned. So you want to know how to manage your position. You want to know how to roll the position, be prepared to maybe even buy the call back if it goes up too fast, too quickly. But that's probably the biggest concern. On the way down, no concern whatsoever, because the short call option should help you, right? It should be going down in value, meaning that you've sold it at a higher price than you would be buying it back at. And the only thing about that too is that if you are nervous, like let's say it went down to the 150 strike, which I've been highlighting, and I want to get out of that trade, what I would do in that scenario is you got to make sure that you buy the call option back before you sell the leap option if you're nervous about it going to the downside. Now, if you do that, you can do it all as one trade. You can enter it in the option space. It would be an unwind. You'd be buying to close the short option, selling to close the long option contract. So it's very feasible to do that overall. But with that said, a lot of people might just close the long option or the short option to start with, and then work the leap to try to get a better price overall. All right, let me scroll down, see if we have any more questions. We're at time. Yeah, we're a couple minutes over. So that's going to be it for this episode of the Stock Play of the Day. We'll come back on Friday, and maybe we'll look at selling a call option against it. Let's see where the underlying stock goes. And most of the time, if I'm doing a trade like this, I would normally buy the leap, hope that it went up, and then sell the call at a later date. Now, why is that? Just overall, when you're buying, why am I buying the leap? Because I think it's going up, right? That's why I would buy the leap. So why do I want to sell a call right away against it if I'm looking for some upside? That's the reason why I got into the position to start with. And that's also usually true with stocks. When you're looking at covered calls on stocks, most of the time people buy the stock, hopefully the stock goes up a little bit, and then they eventually sell a call against the position overall. All right, so please click subscribe, ring the bell. We'll see you this Friday, and we'll look at adding a call option, a short call option, to our long-term leap in GM. Thanks for coming, everyone.